Welcome to Health Reform Beyond the Basics. Thank you so much for joining us today. Beyond the Basics is a project of the Center on Budget and Policy Priorities. It's designed to provide training and resources to facilitate enrollment in the health insurance marketplace and Medicaid. We are a nonprofit policy organization and are not a part of the U.S. Department of Health and Human Services. Beyond the Basics is aimed at healthcare assisters, advocates, state and local officials, and others who help people get and keep their health coverage. This webinar series is not intended for press purposes. Today's webinar is the first in a 9-part series of webinars that will cover a range of enrollment topics. Webinars will be held at 2 p.m. Eastern, 11 a.m. Pacific on Tuesdays and Thursdays throughout October. You can register for upcoming webinars at www.healthreformbeyondthebasics.org. After the webinar, we'll circulate the slides, a video recording of this presentation, and other resources. We'll also post everything to the Beyond the Basics website. All participants are muted and in listen-only mode. If you'd like to ask a question, click on the Q&A icon in the control panel at the bottom of your webinar screen and type your question into the box. We'll be monitoring questions and we'll pause for Q&A during the presentation. We may not be able to answer every question asked, but we will have a record of all of your questions and we'll use them as a guide for future resources and presentations. You can also email any questions during and after the webinar to beyondthebasics@cbpp.org. Today's webinar will be an in-depth review of household and income eligibility rules for premium tax credits and Medicaid. Today's presenters here at the Center on Budget and Policy Priorities are Tara Straw, Senior Policy Analyst, and Shelby Gonzales, Director of Immigration Policy. With that, I'll let Tara take it away.
Thank you so much, Ina. We're starting the webinar series with this tax lesson because these are the building blocks of the eligibility determinations. If these elements are wrong, household size, dependence, income, someone may be determined eligible for the wrong program, the wrong amount of assistance, or no assistance at all. So as you know, the federal poverty line calculation requires a calculation of household size. So this is the number of individuals in a household and then the income of those household members. And this is needed to determine eligibility for a premium tax credit, a cost sharing reduction, as well as Medicaid eligibility. You can see here the expected premium contributions for the 2020 plan year. For the lowest income people, they start at just about 2% and they rise according to income until someone is at 300% of the federal poverty line, where the top contribution is 9.78%, and that continues to 400% of FPL. After 400%, someone is not eligible for premium tax credits. And here you can see a table that has those same numbers, as well as the monthly dollar amount of the premium that someone would be expected to pay. So we're going to talk about tax filing. If someone has the wrong tax filing status, they may be ineligible for premium tax credit or get the wrong amount. For example, if someone says they are not married, but in fact they are married, their household size will be wrong. So here's a quick tax lesson on filing statuses. A person is single if they are unmarried or legally separated or divorced. And so when someone is asked the question on the application of whether they are married, keep the definition of single in mind. A person is married and can file jointly if they're legally married, whether they're living with or apart from their spouse, and they file taxes together. A person is married filing separately if they are legally married, whether they're living apart or are together with their spouse, and file taxes separately from their spouse. Head of household is a status for people who are unmarried or considered unmarried for tax purposes, and we're going to dive into that, that term. Pays more than half the cost of keeping up the home for a qualifying person whom he or she will claim as a dependent. And finally, there's a special tax status for a qualifying widow or widower, with a dependent child. That's not really relevant for our purposes for calculation of the premium tax credit. A person who is a widower would be considered not married. In general, a person who is married has to file jointly with their spouse in order to be eligible for a premium tax credit. But there are some exceptions, and there's a new element that we're going to talk about in particular. There are 3 exceptions. The first one is someone who is head of household, and there are some new questions on this, yay, so we can avoid one of the workarounds we've been talking about for the last several years. Another exception is someone who is a survivor of domestic abuse, or finally, someone who is an abandoned spouse. And remember that for, even though a person may be ineligible for PTC if they are married filing separately, that doesn't disqualify them from being eligible for Medicaid or from being eligible to purchase health insurance in the marketplace at full cost. So let's run through the test for someone who is married as head of household. Now, if someone is unmarried and head of household, that's really not relevant for the determination of whether someone gets premium tax credits. Because if they're unmarried, when they're asked the question, are you married? They'll answer no, and they'll go on their merry way. But if someone is married and they are filing separately from their spouse, it's important to keep this test in mind because this can move them out of the box of married filing separately and into the head of household box, which makes them eligible for premium tax credits as long as all the other tests are met. So here's a rundown of the test to be considered unmarried. Will you file taxes separately from your spouse? Will you live apart from your spouse from July 1st to December 31st, the last 6 months of the year? And here we're talking about the last 6 months of 2020. Will you pay more than half the cost of keeping up your home? Is yours the main home of your child, stepchild, or foster child for more than half the year? And finally, are you eligible to claim the child as a dependent? And there's a special rule that you can meet this test if you're eligible to claim the child, but the child is instead claimed by a non-custodial parent. So in order to qualify as considered unmarried and to be able to file as head of household, a married person has to be able to answer all of those questions yes. So here are some new questions that you're going to see in the application this year that delve into that head of household filing status. If you'll remember before, we had to do a workaround. And so if someone met all of those tests that we just discussed, they were able to say, no, they were not married. But now the application is going to ask more specific questions to try to get at the answers to that test without needing a workaround. We've abbreviated this a little bit in the interest of space to take out some of the questions related to the address of the spouse, but you get the idea. So first, someone will be asked if they are filing a joint return with their spouse. This is a question that they've seen before. So if they answer no, they're going to be given this warning that if you're filing taxes separately, you may not be eligible for premium tax credit, but you are potentially eligible for Medicaid or CHIP. A person's asked if they're going to file a federal income tax return. Again, that is a question we've seen before. They'll be asked if they have dependents on the return and whether whether they'll claim a tax dependent on their return, and then to verify the person that they'll claim. Then they're asked about the address of the spouse. And so this will give the application, the dynamic application, information about whether the spouses are living separately. So remember that rule about living separately for the last 6 months of the year. And then finally, after all of that, if a person appears to be eligible to file as head of household, they'll be asked directly if they plan to file as head of household. And these 2019s will say 2020 once the application flips over. If a person answers no there, then remember they'll still be counted as ineligible for a premium tax credit. So they will have to know a little bit about tax filing status. The help text should be really helpful. So here's a quick example of head of household in this considered unmarried status. This is Marissa and Amelie. Marissa lives separately from her husband, but they're not yet divorced. They will not file taxes together or live together at any point in 2020. Amelie is Marissa's teenage daughter. She lives with Marissa during the school year and with her father during the summer. So if you go through all of these questions, you'll see that Marissa can answer yes for all of them and qualify as head of household because she's considered unmarried by the IRS. Even if Marissa indicates that she's married and not filing taxes with her spouse, she should be determined eligible for PTC, assuming she meets all the other requirements, under the new questions that the application is asking. Now, they're new questions, and we don't want to be Debbie Downer about it, but since they're new questions, keep these rules in mind, and if something isn't quite working or isn't quite making sense about the determination about whether someone is premium tax credit eligible, you might want to go back to these questions, make sure you've answered them correctly, and sort of make sure that everything is flowing through in the application. So let's change the scenario. What if Marissa moves out of the area to care for an ailing relative and Amelie moves in with her father to finish her last year of high school? So if she's going to live with him more than half the year, then all of a sudden, Marissa is unable to answer all of these questions yes. And because of that, she's not going to be able to claim the head of household status because she's not going to be the main home of her dependent child for more than half the year. We said that there were two other exceptions to the joint filing requirement. A married person can claim to be unmarried on the marketplace application if either of these circumstances occur. One, they're the survivor of domestic abuse, and two, they're an abandoned spouse. So in either of these cases, the person, when asked if they're married, is going to say no, and that's permissible. And then on their tax return, when they file as married filing separately, there will be a box they can check on their Form 8962 to indicate that they qualify for one of these statuses. A person can qualify for the domestic abuse exception if the taxpayer is married filing separately and lives apart from their spouse and is unable to file a joint return because of domestic abuse. An abandoned spouse is one who lives apart from their spouse and is unable to locate a spouse after using reasonable diligence. Now, as I said, the workaround is still needed. People always ask what kind of verification the IRS may ask for. There's no specific documentation that the IRS needs, but like anything else on your tax return, you should be expected to, be able to prove it or to be able to make your case. So for instance, someone who's claiming to be an abandoned spouse should, note what they did to try to locate the spouse, what relatives they called, what friends they called, etc. But there's no specific documentation requirement. Determining households for premium tax credits is built off of all of that. The household is the individual's tax unit. It includes everyone who's on the taxpayer's return, including the taxpayer themselves and spouse and tax dependents. A household is going to include all individuals in the tax unit, even if they're ineligible for a premium tax credit or they have some other source of insurance coverage. So as we said at the beginning, the household size is determined by everyone in the tax unit. So don't leave someone off just because they have other coverage. Otherwise, your FPL percentage will be wrong, and that just kind of screws up everything. Household size is based on the expected tax filing status for the taxable year in which the premium tax credits are being claimed. One thing that I didn't note that the marketplace has made a point of before is that if someone is married but they're anticipating divorcing by the end of the year, they should still at the point of application say that they're married, and then once they have a change in circumstance like divorce, then during the year they can indicate that. But there are some special rules about what kind of projections you are able to make related to filing status. It's important to understand the rules about who can be claimed as a tax dependent because the marketplace application doesn't really walk you through this. Instead, they'll just ask the question directly who you're going to claim as a tax dependent. There are two kinds of tax dependents. One is a qualifying child and the other is a qualifying relative. A qualifying child can be more than just a child. It can be a stepchild, adopted child, or a brother or sister or niece, nephew, or grandchild. The person needs to be a US citizen or a resident for tax purposes of the United States, Canada, or Mexico. And if they're a resident of Canada or Mexico, they'll need to have what's called an ITIN, a taxpayer ID. The person has to live with the tax filer for more than half the year. There are exceptions for things like living out of the area for school. A person needs to be under age 19 at the end of the year or under age 24 if they're a full-time student, or any age if they have a disability, a permanent disability. And the dependent needs to not provide more than half of their own support. There is an exception for children of divorced or separated parents. A parent that claims the child as a tax dependent is the one that can claim PTC for the child. Usually this is going to be the custodial parent. And so the custodial parent claims the child and claims the premium tax credit. But sometimes the child is claimed by a non-custodial parent. In this case, this is a formal arrangement. This isn't kind of an ad hoc deal when people file their taxes. This is a formal arrangement. And the custodial parent needs to sign a tax form that grants the non-custodial parent the child's exemption. That's called Form 8332. And if they're permitted to claim the child as a dependent, then the non-custodial parent will also claim the premium tax credit for the child. The other kind of tax dependent is a qualifying relative. This includes virtually any other type of relation, except cousins, strangely, or a full-time member of the tax filer's household who's not a relative. And by full-time member, we mean 365 days of the year this person lived with the tax filer. The first rule of being a qualifying relative is that the person cannot be claimed as someone else's qualifying child. So qualifying child sort of trumps a qualifying relative. The person, like in the other test, has to be a US citizen or resident of the US, Canada, or Mexico. The dependent needs to receive more than 50% of his support from the tax filer. Note that this is different from the test for a qualifying child. For the qualifying child, there's no requirement that the tax filer be providing more than half the support. It's the other way around, that the child needs to not be providing more than half of their own support. But for here, for qualifying relative, it's whether the tax filer is providing the support. The tax dependent has to be related to the tax filer or live with the tax filer all year. And there's a gross income test. They have to have gross income less than $4,200. That's the number for 2019. I don't think the IRS has released the 2020 figure yet, but I would assume that it's about the same amount, or probably $4,250. So let's take a quick look at another example, Jane. Can Jane be claimed as a tax dependent? So she's 27 years old. She lives with her parents rent-free, and she works as an unpaid intern and has no earnings. Isn't Jane lucky to have such great parents? So the first question you're going to ask is whether Jane can be claimed as a qualifying child. And of course, the answer here is no, because she doesn't meet the age test. Even though she meets all the other tests and is their child, she doesn't meet the age test, so she's not a qualifying child. But you can look at her under the test for a qualifying relative, and you can see that she's going to meet that test. She meets all the requirements as a qualifying relative, and so when her parents are completing a marketplace application, Jane can be listed as a dependent. Let's look at another example of Jay and Kim. They live together, but they're not married. Kim earns $24,000 a year. Jay is a musician, and he earns $3,500 a year. So obviously there's, he can't be a qualifying child, but could he be a qualifying relative? So you go through the test. He's a person who lives in her home all year. He gets more than half of his support from Kim. He has gross income less than $4,200, and so he's going to meet the test as her dependent. And next, I'm going to turn it over to Shelby to talk about determining households for MAGI Medicaid.
Thanks, Tara, and hello, everyone. I really can't believe that open enrollment is almost here. It feels like it's still summer here in DC, although it feels like winter in this room. All right, so I'm going to go through the methods for defining households in Medicaid under the rules when modified adjusted gross income is used to make a Medicaid eligibility determination. There are several differences between Medicaid and premium tax credit households. While the premium tax credit household is pretty much, well, it is the tax filing unit, not pretty much the same, it is the tax filing unit. In Medicaid, there are a lot of exceptions. The good news is that the eligibility systems are at least supposed to automatically figure out what the household size is based off of how individuals answer the questions on the application process. So no one's expecting you to make that determination as somebody who is helping somebody through the application process. It's supposed to be baked into the rules, but as Tara mentioned, it's very important for folks to know about them because sometimes it's confusing. Sometimes the application doesn't yield the results that one would expect. So it's important to be familiar so that you can spot when there might be an issue. So here we go. In Medicaid, MAGI rules apply to people who are in the Medicaid categories for children, pregnant women, parents and caretaker relatives. And this is the case whether or not a state expands Medicaid. And in states that have expanded Medicaid, MAGI rules also apply to the new adult group. MAGI does not apply to people who qualify for Medicaid because they're either seniors or people eligible based off of a disability. Medicaid looks at each individual's tax status as well as their relationship with other household members in order to arrive at a separate determination of household for each individual family member. In some cases, households will be the same for all members, but in many cases it won't. There are 3 different rules that apply based on individuals' tax filing category. These include rules for I'm going to go through this slide. These include the rules for people who are tax filers who claim their own exemption, people who are tax dependents, or people who are neither tax filers nor tax dependents. For all groups, rules that are applied are based on how people expect to file rather than what they filed in the previous year. So this chart, I'm sure, looks familiar to a lot of you. If this is brand new to you, then I really recommend printing this up and having it as a handy tool because it really does help walk through some of these otherwise pretty complicated rules. So first, let's look at the rules for tax filers. The household of a tax filer who is not claimed as a tax dependent by another person includes the tax filer and all people that the tax filer expects to claim as a dependent. Okay, next so that one's pretty straightforward for the tax filer. Next, we're going to look at the rules for tax dependents. In general, the rule is that the tax dependents have the same household of the tax filer who's claiming that dependent. But there are 3 different exceptions that apply to this rule. First, a tax dependent who is not a child or a spouse of the taxpayer. For example, this could be a parent an adult sibling or another non-relative who is being claimed as claimed by the taxpayer as a dependent that's living with them. So like, let's say my aunt was living with me. That kind of exception would come up in that circumstance. Second exception is for children living with both parents who are not married. In that case, those two parents can't file taxes jointly. They would be filing separately. So that group, so children are looked at a little bit different in the case that both parents are there in the household, but they're not married. Third, children who are claimed as tax dependents by a non-custodial parent. As Tara mentioned, under certain circumstances, this happens. And this is always going to be something that is agreed upon between the two parents. Okay, if any of these three exceptions apply, or if the applicant is either a non-filer, so it's a person who does not plan on filing taxes, nor is that person, or is the person neither going to be filing taxes him or herself, but also will not be claimed as a tax dependent by anybody else. So then these other rules apply, which now I'm on the last column. We call it the non-file or non-dependent rules. In the case that the individual, you're going to use, if the individual is 19 years old or older and is in this column, then the household includes the individual, and if living with the person, spouse and children up to age 19. For individuals under 19 years old, the household is the individual and siblings under 19, parents, and children living with the individual. It's important to note that there are additional situations to be aware of that are at the bottom of this slide. So for example, pregnant women are treated very differently in the household counting for Medicaid eligibility if compared to how PTCs would count to pregnant women. In Medicaid, a pregnant woman's house always includes herself plus the number of children she's expecting. In addition to, of course, applying any other rules that we've already covered above, right? For individuals in a household that includes a pregnant woman, so not the pregnant woman herself, but other people within the household, states have the option to count the pregnant woman as either one or two people, or they also have the option to count the pregnant woman as herself plus the number of children that she's expecting. So I also provided a summary of the household rules in this tool that walks you through using a flow chart of yes and no's. I'm not going to walk through it right now, but it's another tool that we recommend just having at your fingertips. So let's look at an example. In this example, we have Teresa and Antonio who are married and they have two children, Gabby and Michael. Teresa and Antonio are tax filers and Gabby and Michael are their tax dependents. This is a pretty straightforward example. In this case, all family members have the same household sizes. Now we'll get a little bit more tricky. Here we have a 3-generation household. Sonia supports her mother, Diane, and her daughter, Kyla. Sonia is a tax filer and she claims both her mother and her daughter on her tax return. So what are the households for Medicaid? Oops. For Sonia, she's a tax filer and she claims 2 dependents for her house. That makes her household size 3. It counts herself and her 2 dependents. Next, we have Kyla. Kyla is Sonia's daughter, and her and she is also Sonia's tax dependent, and she lives with her. So none of the exceptions apply. So her household is the same as her mother's. It's also a household of 3. Okay, now let's look at Diane. Like Kyla, she's the tax dependent of Sonia's, but her household is of 1. So why is that? Let's think about that. So one of the exceptions does apply to her. She is a tax dependent, but she's not the child or spouse of the taxpayer. In this case, we have to apply the rules for non-filers. And under those rules, as an adult, her household includes herself plus her spouse or her children under age 19. Even though she's living with Sonia, which is her child, Sonia is not under 19. Diane is in the household by herself for a Medicaid MAGI household. Next, we have Dan and Jen and their 2 children, Drew and Mary. Dan and Jen are not married, so they can't file taxes jointly. Jen claims the 2 children as tax dependents. So Dan, as a tax filer with no dependents, has a household size of 1. Jen claims 2 children as tax dependent. And Jen claims her 2 children as tax dependents and has a household size of 3. And Drew and Mary use the non-filer, non-dependent rules because they live with both parents who do not expect to file taxes jointly. Their tax household size is 4.
So Ina, do you want to give us some questions?
Yep, absolutely. And as a reminder, if you'd like to ask a question, you can click on the Q&A icon in the control panel at the bottom of your webinar screen. Type your question into the box and we will be monitoring questions, and we'll pause for Q&A one more time at the end of the presentation. So a few of the questions we've gotten in so far. Is domestic abuse and abandonment entered into the application only through the call center?
No, you don't have to go through the call center to do that. In this case, you are able to use a workaround by saying that the person is not married. So when you're asked the question directly, is this person married? According to the workarounds, you can say no.
What if the applicant has an adult disabled child? Can they be included on the parent's application / health plan?
So if the person has an adult child with a permanent disability, that child is probably covered through other insurance coverage or maybe through non-MAGI Medicaid or possibly even through Medicare. So in this case, yes, you would include the person in the household if they meet the test for dependency. So you would need to go through the dependency test, paying special attention to the support test and the income test, especially the support test, and determine if the person is a dependent. If the person is a dependent, they'll be on the application as a member of the household, and so they'll factor into household size and the determination of MAGI. The likelihood is that they'll have other coverage though, but remember that they still go on the application.
Great, and one more question. Does it matter which parent claims the child as a dependent versus which parent is the child's primary caregiver?
It depends. So if a parent, so remember that we had special rules for non-custodial parents. And so if you're asking whether a child has to be living with the parent in order to be on their application, the answer is a little tricky because you want to get the right tax filing household size. That's the most important thing. But for Medicaid, the answer may be different. And so there are some complicated rules related to having a person on an application as a non-applicant that will come into play. It's a little beyond what we're going to talk about here, but the questions do walk we'll touch on it a little bit, but the questions do walk you through that.
That's right. They do, but they ask you about whether or not somebody is the primary caregiver, and it does matter sometimes not only for the child's eligibility and whether or not what their household size is, because that could change things up, but it also matters for potentially that parent or caregiver's eligibility as well, because there is eligibility. A category of eligibility that opens up for somebody as a potential if they meet all of the requirements by being the caregiver.
Great, thank you. And one more question. Does the tax filer income, the tax filer income count towards an adult that is claimed as a tax dependent? Does the tax
so I think that,
and as an example, the mother living with her adult child.
So so if we've established that the adult child is a dependent, then yes, you count the mother's income because that is the household unit for the purpose of the premium tax credit. So let's move on to talk more about income. That's a good segue. And we'll talk about what constitutes income for the premium tax credit and Medicaid. So here's our basic formula. If you've been doing this for a while, you are used to it. It's adjusted gross income plus non-taxable Social Security benefits plus tax-exempt interest plus excluded foreign income. I'll tell you, excluded foreign income is a unicorn. We're not going to talk about it. If you see this, it is super complicated. So get ready to get out your tax books or consult a tax preparer. I'll just note the non-taxable Social Security benefits. Sometimes people ask, well, what about the taxable Social Security benefits? They're already counted in AGI, so we don't want to double count. That the Social Security addition is just the non-taxable portion that isn't included in AGI. You add those up to get modified adjusted gross income. Remember that income is a very broad definition for the IRS, and that includes cash income. Even if there are lots of reasons that people say they don't want to put it on the form, like I haven't declared it in the past, I haven't put it on my tax return, it's a side job, it's not my main job, I work seasonally or just sometimes. Any of these reasons, it's still income, it's cash income, so it needs to go on the application. All income is taxable unless there's a specific exclusion in the law. I highly, highly recommend that you have at your fingertips or at your Google fingertips IRS publication 525, which lays out in excruciating detail the kinds of income people can have and whether it is considered taxable or non-taxable. Some of the non-taxable forms of income are child support payments, SSI, which is different from Social Security, veterans benefits, workers' comp. We get a lot of questions about veterans benefits in particular. And I think that there are some state Medicaid agencies that are not doing this right, just by the number of questions that we get about certain categories of non-taxable income. And I can tell you that just showing them this slide is probably not going to be sufficient to get them to change their accounting of income. So if you are having trouble with getting someone through Medicaid and you're pretty confident about that their income is non-taxable, then your go-to publication is going to be IRS publication 525. Pre-tax deductions like retirement contributions are not included in MAGI. Social Security, including survivor's benefits and SSDI, remember that even the untaxable portion is included in MAGI, in the MAGI of a person with a filing requirement. And finally, the rules for alimony changed with the 2017 tax law. Starting with judgments after January 1st, 2019, neither spouse includes alimony on the tax return. It used to be income for one and deduction for the other. And other under other divorce decrees, they can choose to adopt this method, but they need to do a a formal go to court kind of change in order to do it. Estimating self-employment income is particularly challenging because this income is often variable, and there are also expenses you can deduct which can be hard to predict. So our advice for estimating income is asking, assuming the person doesn't have a formal written record, you would hope that they come in with a very good estimate of their income, but I'm sure that there are many cases where this just doesn't happen. So I kind of tease out the, some questions just to get the conversation going. Ask if they have regular monthly income. So maybe they have 4 clients, 1 client a week, and they can estimate what that income is. If there's no regular income, what jobs do they know are lined up for the year, or can they reasonably anticipate they'll get? If there's no good estimate, consider adding or subtracting from last year's income. So do they think it will be the same or different? And you can also try to make estimates by the job or by the month, using receipts, invoices, bank records, anything from the current year that might seem relevant for the next year. Expenses are deductible, some expenses. If the person has regular monthly business expenses, you can discount those. If they have large expenses, find out whether they anticipate having large expenses. What expenses do they have in the current calendar year? And again, receipts, credit card, debit records, known costs, these are all really helpful. The kinds of business expenses that can be deducted: advertising, commissions, legal fees, office supplies, rent, telephone utilities. You are really best served by the advice, the old adage, when in doubt, leave it out. Because when it comes to expenses, because you would rather, in most cases, overestimate income than underestimate income if you're dealing with someone who's in the premium tax credit range. Because if someone is near the top of that range, you don't want a circumstance where they're going to owe back a lot of money because you underestimated income or overestimated expenses. So keep that in mind. And again, it's just really challenging there. And encourage someone for the next year to keep better records. Unfortunately, we don't have a silver bullet advice on this one. Okay, one thing that gets super tricky is when to count a dependent's income. Remember that household income is the MAGI of the tax filer, plus the MAGI of all tax dependents who are required to file a tax return. And here's the test to determine whether a single dependent who's under age 65 has a tax filing requirement. And this is the test for 2019, but 2020's test will, I'm sure, look quite similar. A dependent will have a tax filing requirement, and so their income will be included in the household MAGI if they have unearned income that's more than $1,100. Unearned income is generally investment type income, or something like unemployment compensation or taxable Social Security benefits. Earned income that is more than $12,200, or taxable gross income that is some combination of the two. The earned income has changed a lot, and that was due to the 2017 tax law. So it used to be much less than this, and so more dependents triggered that filing requirement, but now very few will, especially among our low-income tax filers, because frankly, for a lot of the lower income folks that you guys will see, if a dependent is earning more than $12,000 in income, then there's a good chance they're not a dependent. So you'll need to do the dependency test, and I think it'll be a relatively small sliver of people who are dependents and yet have income you know, that's quite high. So high enough to trigger a filing requirement. So I don't expect that you will see this very often, but just be aware that the rule has changed. And so even if you've included someone's income in a dependent's income in the past, that may not be necessary anymore. So we're going to do a quick example here just to illustrate the point. But again, we've had to kind of twist this example a little bit over the years just because of this change. It used to be, again, much easier to trigger for a dependent to trigger that filing requirement than it is now. This is Jill and Ryan. Ryan's her 17-year-old grandson. She claims him as a tax dependent. And I'm going to stop there because remember the first question to get to any of these examples about whether someone's income is going to be included is whether they are a tax dependent. So you've got to do these tests sequentially. So we're establishing that Ryan is a tax dependent. Jill's income is $18,000. Ryan's income is $13,000 from Social Security survivors benefits. Now, I will say in the real world, Ryan's income might be used to pay household expenses. If it's used to support himself and he's paying more than 50% of his own support, he's not going to be a dependent. Now, in this example, we'll say that his benefits are not used toward his support. Let's say Jill is really diligent about stocking those away in a savings account. So in this case, whose income is going to be counted? It's only going to be Jill's income. They're both going to be a household of two. In the same household, they're both going to have income of $18,000, and they'll be at 106% of the federal poverty line. Ryan's income isn't counted because he doesn't have a tax filing requirement in this example. Why? Because it's Social Security benefits. And you know, one thing that people get confused on, and that can be really confusing, is the test for a tax qualification versus the test for MAGI. So in Social Security benefits in particular, remember that they're treated one way when we're looking at issues like, is the person a dependent, and does the dependent have a filing requirement, when we're looking at tax determinations. But Social Security is treated in a different way if we're looking at a MAGI determination. So here, because he has no tax filing requirement, his Social Security is not counted. But let's say that instead he has a part-time job that earns him $13,000. Well, he's over the $12,200 of earned income, and therefore his income is going to count in the household income. And so Ryan's, so their total income is going to be $31,000. Now let's say he has both. He has both a part-time job and Social Security survivors benefits. Well, I can tell you right now, Ryan's not a dependent. Because with that income that's greater than Jill's income, he is probably paying more than 50% of his own support. I don't believe that he's saving all that money. It's going toward household expenses. But for the sake of argument, let's say that he's a tax dependent. In this case, the fact that he has a tax filing requirement is going to trigger not just the addition of his part-time job income, but also the addition of his Social Security survivors benefit income. Because that is a part of the MAGI calculation. And so in this case, the household income will be much higher. And now Shelby is going to do the hard stuff.
I think what you just did was pretty hard, but I'm going to run through one complicated piece that we've heard a lot of people run into this type of situation in the past. And the situation I'm talking about is a sticky situation that occurs because there's a difference between what time period Medicaid will generally use when making an income eligibility determination and what time period is looked at in terms of income for the purpose of premium tax credits. So as you know, if you've been doing this type of work for a while, and as you will soon find out, if this is your first time doing this type of work in this open enrollment period, this situation can be really tricky, and it's oftentimes even trickier because people's lives are complicated and they change quickly and frequently. You know, people's income goes up and down based off of things that are really outside of their control often. So let's take a look at, sorry. So generally, Medicaid looks at current monthly income when making an eligibility determination for new applicants. Eligibility for advanced premium tax credits is based off of projected annual income for the coverage year. And then, of course, the final determination of eligibility is made when the premium tax credit is reconciled during tax completion. That then looks at actual annual income. We're going to look at an example of how this could all come into play. We have Carla, who works in retail and lives in Ohio, which is a state that expanded Medicaid for adults. So the income standard for adults in Medicaid is effectively 138% of the federal poverty line. In November, when she applies for coverage in the marketplace, and we're going to say she's applying in healthcare.gov since Ohio is a state that uses healthcare.gov. She provides her income information, and for November, her monthly income is going to be $1,370, which would put her at 132% of the federal poverty line. And she projects that her income for 2020 will be $17,000, which would put her at 136% of the federal poverty line. This is a little bit higher because she knows that she works more hours during certain busy times of the year, like back to school or the holidays. The marketplace assesses her eligible for Medicaid and transfers her case to Medicaid in late December. It's important to know that there's often this type of delay in the transfer of people from healthcare.gov to Medicaid. This is not an unusual circumstance. It's not as if when you're helping somebody complete an application on healthcare.gov this is all happening instantaneously. There are batches of people that are sent, and there's sometimes some delays that are not in the form of days. Could even be weeks at times. Now, we don't know if that's going to be changing in this year, but certainly we've seen this kind of thing happen in the past. So it's not generally an instantaneous thing. So Medicaid asked Carla to provide her most recent pay stubs. So, now we're into December, and she does provide her, pay stubs that reflect increased hours because she was working more hours during the holidays. And Medicaid looks at that income, and they compare it to the income that was on the application. They find it to not be reflective of the attestation of the income. And they find that if that's her income, then she would be ineligible for Medicaid in December. A couple of things to note in this example is that yes, for December, because Medicaid again is looking at monthly income. For December, if her income is over the Medicaid range, the state may make that determination of ineligibility because her income is over the threshold. That does not mean that in November, Carla wasn't eligible for Medicaid. And Carla completed a Medicaid application in November because healthcare.gov application is indeed a Medicaid application. So that locks her in to potentially, assuming she met all other requirements for Medicaid. And let's say if she had some kind of medical expense during that month, she could potentially be eligible to get Medicaid to cover those expenses. So that's a level of complexity that she might actually need some help in making all that happen. And she might turn to you for help. So it's important for you to know that that's something that could happen. And in fact, in most states, she could even be, potentially have been eligible, retroactively even further, back into the past. So just something to keep in mind. Also, sorry. Also, states have the option to smooth out some of these kind of turbulences that cause consumers, you know, that to have all this kind of back and forth between the marketplace and Medicaid. So it's kind of important for you to know what's happening in your state. In some cases, states will go ahead and annualize at the point of application income, or they might, so in that case, they might have asked Carla, so is, you know, there, you know, what's the discrepancy? Is it, you know, what do you project your income would be for the remainder of the year? So anyway, there's just some different things to keep in mind. There are a lot of moving parts that could potentially happen. But in this case, we're going to assume that Medicaid made the determination that she was ineligible for Medicaid based off of her December income, and Carla is referred back to healthcare.gov. And in this case, Medicaid would send her a notice indicating that she was found to be ineligible for Medicaid, and hopefully would say that she is being transferred to the marketplace and maybe give some helpful information, but I wouldn't count on it. If we've ever read a notice, they can be tricky to read. What else will happen is that in this kind of circumstance is that Carla will get a marketplace notice when her Medicaid is denied, and again, not instantaneously, it will happen eventually. She will get a notice that contains language. This is a version of what language was provided to people in the circumstance last year. We don't, you know if there'll be any changes this year, but basically the notice will redirect Carla to, to the marketplace and encourage her to take certain steps that would then help her to establish eligibility, to figure out whether or not she's eligible in the marketplace. I just want to say that this is a place where we think there's a lot of risk for people falling through the cracks. In fact, I think transitions in general between Medicaid and the marketplace are big risk points. It's very confusing to the consumer, this back and forth. And you can imagine that Carla completed an application on healthcare.gov, may not have really fully even realized what was happening when she was being sent to Medicaid. Certainly isn't going to then realize if that was the case, it would be very difficult for her to understand and keep track of what was happening when she was being redirected once again. So now we're going to go through a couple of kind of complex, we're going to kind of put these scenarios together. So because we've reviewed the premium tax credits and we've reviewed the Medicaid households and income rules, so we're going to put it together in a couple scenarios. The first one we have Sonia, Kyla, and Diane again. Sonia lives with and supports her mother, Diane, and her daughter, Kyla. Sonia makes $35,000 a year. Diane has occasional work and makes $3,000 a year. Sonia is a tax filer, and she claims both Diane and Kyla as tax dependents. So let's see. Okay, I just wanted to see if there was any special animation. Sorry. So let's see. How does eligibility for each of the family members work? The marketplace will first try to determine if any of them are eligible for Medicaid using Medicaid rules. We determine Sonia and Kyla have household income of $35,000 a year, and their household size is 3. This puts them at about 164% of the poverty line. Depending on the state, Kyla may qualify for Medicaid or CHIP, and Sonia will qualify for PTCs and cost sharing reductions. Even though Diane is in Sonia's and Kyla's household, her income isn't counted, as Tara mentioned before. Income of tax dependents only counted in MAGI if the tax dependent has a tax filing requirement, and she does not. Diane is in a household of size of 1. Her income is only the $3,000 for the purposes of Medicaid, which puts her at 24% of the federal poverty line. So she would qualify for Medicaid if her state expanded Medicaid eligibility for adults. If not, let's see if she would qualify for premium tax credits. For premium tax credit eligibility, Diane's household size is equal to the household size of the person claiming her as a tax dependent. That means her household size is 3. And Sonia's income counts towards her eligibility, so she is also at 168% of the federal poverty line, just like Sonia and Kyla. And she would qualify for PTCs and CSRs. Next, we're going to look at Dan and Jen again. Dan and Jen live together with their children, Drew and Mary, but they are not married. For Medicaid, Dan is a household of 1 and his income is $18,000 per year, putting him at 144% of the federal poverty line, not eligible for Medicaid. For PTCs, his household size and income are the same. He is eligible for PTCs and CSRs. Jen's household size is 3. It includes herself, her 2 children that she claims as tax dependents. Her household for Medicaid is 3. Her income is $26,000, which puts her at 122% of the federal poverty line. If her state expanded Medicaid, she would qualify for Medicaid. If not, she would qualify for premium tax credits and cost sharing reductions in the marketplace. Drew and Mary have the household size for Medicaid of 4, and the income of both parents would count for Medicaid purposes. So their income is $44,000 per year. They would be at 171% of the federal poverty line. They would most likely qualify for Medicaid or CHIP in their states. If they did not, but again, in most states they would, if not all, the marketplace would say their household size is the same as Jen's because Jen claims them as tax dependents, and it would say the children's income was that of their mother, Jen, at $26,000 a year, which would mean they have the income at 122% of the federal poverty line. Then the PTCs and CSR eligibility would be based off of that income.
Great. Thank you so much, Tara and Shelby. Unfortunately, we won't have time for any more questions today, but if you do have questions, please feel free to email us at beyondthebasics@cbpp.org.gov.